Hello, everyone, and welcome back to another episode of Spark Your Fire. I'm your host, David Shih, and as always, I've got the Smiley John Comino, Mr. Comino, with me on the other side of the camera. How are you, mate?
Hi, David. I'm good. Smartest guy in this room today. I'm here by myself, so that was counts. But no, I'm very well. How are you doing?
Good, mate. Good. Always happy to have you on board, as always. So, yeah, and I know you've got big projects coming up as well. So, yeah, let's see how that pans out. As we might have to change our schedule again, but we'll work it out. We'll work it out. That's for sure.
Always time for this.
Yes, exactly. So just passed a long weekend. Hope everyone had a fantastic time. And first week of October, we've just got the official cash rate handed down from our first female governor, Michelle Bullock. Her first meeting as well in terms of the monetary policy decision. John, I think, would it be safe to say, I think most people kind of guess it's going to be a hold this month anyway, so there wasn't much suspense, was it?
Not at all. Yeah, it's exactly what was expected. And I think, if I'm not mistaken, it's been the fourth month in a row that they've been on hold.
It is the fourth month. That's so far.
And that seems to be the prevailing wisdom, that they're going to be on hold for a bit. Eventually, they'll come down. But in all of the statements, in all of the verbiage, it's always about how there's probably one more up our sleeve. There's one more. Don't be surprised if we raise rates again. So I don't think that's what the market's expecting, but I think they want to keep their options open, and they're regularly threatening another increase. So I don't think they want us to think that the next move is down, but I think that the next move is probably down.
Yeah. And I think out of the big four banks, three of them have predicted that I think they this is pretty much it, and only NAB I think is saying that there will be one more, and the likelihood of prediction on when that could come is just on the race day, as a matter of fact.
Right.
Yeah. So. That proves interesting. But look, you are correct. In the statement released straight after the announcement, it was widely anticipated there was no change, but they are still concerned at the moment in terms of the economy, how the future economy is going to pan out. At the moment, the inflation has passed its peak, essentially, and the services inflation, which proves to be sticky overseas, there is risk that could happen to Australia as well at the moment. So that's one of them that's currently monitoring. And we know that oil prices is obviously, has been quite high. I think it just dropped down earlier this week though, isn't it?
Yeah, overnight quite a lot as well. It's nearly at $80. It's about $84, which is
still quite high.
It sort of keeps getting to about $92 and they're getting smacked down, which is good, right? We want lower oil prices, but
hopefully relieves a bit of a pressure on the petrol prices at the moment, which everyone's seeing. But I think the Aussie dollar taking a big hit at the moment is also not helping either. So, the CPI that was released last week, I think it was end of September, showed that I think it was 5.1%, so slightly higher than previous month. But that was mainly caused by the volatile items like the petrol prices. So, So I think it's generally agreed that inflation is pretty much okay at the moment. But having said that, they'll never state that in the statement, and that's why they always put down the fact that there could be one more, or there could be further tightening may be required. That's the famous words I just inherited from Governor Lowe. So definitely never say never, but fingers crossed that we are gonna be on this holding pattern. But there could be a lot more pain to come. I guess the big question is, how long do you think it's going to be holding out like this, right, John? Like, how long is a piece of string, basically?
Yeah, I was comfortable. I could predict interest rate movements up until about 2019, and since then I've been terrible at it. So I'm not sure. I mean, Chairman Powell at the Federal Reserve, and I do believe that there is a lot of collusion with the major central banks. I think that the ECB and the Fed and the Bank of Japan, I think they all talk to each other. Yep. So you find a lot of the same vocabulary. It's probably a good thing. But I think that they are all trying to be on the same page. And Chairman Powell is saying, expect rates to be higher for longer. So don't expect rate cuts. So if we take them at their word, they're probably going to be on hold for a bit with the threat of higher interest rates that possibly never materialize. But again, my credibility on interest rate predictions is just shot. So I have no idea what they're going to do. What I think that they're slightly bothered by is so I think that they measure CPI, and CPI is coming in soft, and that's good. One thing that they don't officially care about, but they do really care about, are things like asset prices, home prices. And home prices are on a bit of a tear everywhere. So it's not just in Australia where we're seeing that them going up. I think a lot of people are scratching their heads, and we can talk about this a little bit later, but now you've got asset prices, rising, even if CPI is coming down. So there are all sorts of different levers that are concerning at the moment, but I don't think consumer price inflation is as big a worry as it was 12 months ago.
Yeah. It's probably comes down to services inflation now, essentially, and unemployment figure will be an interesting one to monitor, I guess, later this week or later this month, which would fundamentally pin down how the rate decision could be next month. So
there are job numbers coming out tonight. So by the time this airs, they'll probably be out. The ADP figures came out yesterday in the US, and they were bad, but they weren't as bad as expected. So, the 10-year yield went back up again. So who knows? I think there's a lot of resilience in the market, and everyone's been calling for a recession later this year. It's always the second half of the year when these recessions. I've predicted 8 of the last 2 recessions. So my record is unblemished with success on this. So who knows? Who knows?
Yeah. Nice one. All right. Okay. Well, thanks for the comments. So we'll keep an eye out in terms of what's going to happen. Given it's first week of October, I think it makes sense for us to delve into the CoreLogic Hedonic Index that was released earlier this month, a couple of days ago, as a matter of fact. So we're going to do a bit of a deep dive today in that, just to I think it's there's a few interesting topics which is thought we'll run through it together, and then we'll get some commentary off John as well in terms of what he thinks, and I might be able to chime in a little bit here as well. So here we are. I think everyone can start seeing that. Hopefully you can see that screen now. So this is the release, Hedonic Home Value Index release on the 2nd of October. Headline: Home Value Index up 0.8% in September as demand and supply imbalance continues to push values higher. Okay, so basically the property values are still going up at the moment. I've highlighted a few things which we use as a discussion point in this sense. The key titles, headlines, for example, CoreLogic Research Director Tim Lawless notes that the performance of the housing market in each city reflects the underlying support dynamic. Okay, so the 3 capitals recording the highest capital gain each have advertised supply levels that are around 40% below their previous 5-year average. So we have a big shortage in terms of the supply that's coming at the moment. The advertised supply level across Hobart, which is on contrary, the other way, where values are still trending lower, have been holding at above average levels since June last year. And we're almost 40% above 5-year average at the moment. So I think this proves to be a big contrast in terms of, the supply value basically determines what would actually be available and what people can buy, and therefore drives the actual prices. John, any comments on that?
Yes. So you went straight to supply. You're right. So housing is going up at the moment. And we talked about this before we came on air, actually. And it's not because housing has suddenly become affordable and everyone's sort of, like the seagulls at the beach after the one chip. There's no supply. So it's not because it's affordable, it's because it's scarce. Correct. So we have a housing supply shortage. Now, for there to be, there's a lot of discussion now, are we in a bubble? Because we're basically at the same levels, but for 1%, I think. We're 1% below the all-time highs back in April 2022. So we're at all-time highs for all intents and purposes. What constitutes a boom, or what constitutes a bubble? And a bubble in real estate is always accompanied by an excess of supply. So there's always got to, so I think 2007 was the last really big bubble we had. That was 2021, no. It was 2007 was about the last big bubble, and there was a massive surge of supply that lasted a couple of years. That's a bubble. So the reason I raise this is because Sydney, Melbourne, Brisbane are not in real estate bubbles, but Hobart might be. So if we're saying there that the supply is 40% above the average of the last 5 years, there we've got an accompaniment of high prices, which are coming down in Hobart, and high supply. And I think that while I don't think we're in bubble territory yet in Sydney, I think we're going to go through the all-time highs. Nor do I think that in Brisbane and Melbourne. Maybe in Hobart we are sort of blowing off a bubble there. The next one to watch, I think, is also going to be potentially Adelaide, although we've covered this in our gold to real estate ratio. Adelaide, which looks like it's probably in bubble territory, was actually just doing a massive catch up. But I do feel like it's getting towards overvaluation there.
Yeah.
So look for oversupply.
Yeah. And I think this is what they're talking about here is the advertised supply level. So in other words, the number of property that's available on to being advertised for for sale, basically. I think that pins down the performance and how much it's grown, because it comes down to a supply and demand equation.
Yeah, there is actually one thing, and I wish I had the stats in front of me, but there is a difference between the total supply of available stock and the new advertised stock.
Yep.
So new advertised stock is rising, but the total available stock, which includes previous stock that was available, that's still very low. But it's supply's on the rise. Supply's on the rise because we're in spring as well. I think that this is sort of a nuance that we're missing at the moment. The supply always goes up at this time of year. That's fantastic. That's as it should be. That doesn't mean that we've got a big surge in supply. We have to look at it compared to the previous years. And again, I'm a bit Sydney centric, but Sydney total supply is still lower than previous years.
Yeah, that's right. Actually, I think you probably jumped the curve, because there is talk about that advertised supply as well as total supply, which was going to be in this, but that's okay. We'll continue on. So as you mentioned, we have since the trough in January, basically the national index has recovered by about 6.6%, and we're only about 1.3% below the record highs in April last year. So, like you and I were just talking off air beforehand about how amazing and how quickly this has bounced back. I don't think anyone has seen this in honesty, right? Like with all the cash rate, with how quickly the cash rate has increased in the last 12 months or 15 months now. It's just mind-blowing in terms of how quickly the values have recovered in such a short period of time. But we are pretty much there, as Tim Lord has mentioned here. At the current rate of growth, we are likely to see the National Home Value Index recover to a new nominal high by the end of November. So in other words, we would be hitting the previous peak and potentially surpass it from November onwards, which is, literally next month. So pretty crazy. It's also worth noting that after leading recovery cycle, the premium housing sector might be losing some steam. So John, I know, I think earlier this year, you mentioned that the upper end of the market was kind of leading recovery cycle, but now it kind of makes sense that due to affordability, the middle and the lower quartile is now starting to push up, because, like the upper end of the quartile is now starting to slow. It's interesting to see that. And in a more expensive city, Sydney and Melbourne, the broad middle of the market is now recording the highest growth rate after previous being led by the upper quartile. So basically, I think people are starting to find the value and what's affordable, and therefore started to push up on that middle of the market level now. So very interesting.
Yeah, I mean, we just have a shortage of housing in this country. It's because we've got rental accommodation that's rising very, very quickly. It's rising at about 15% per year over the last, say, 2 years, and we've got prices that are rising as well. Now we are caught up in what we would describe as a general inflation. So you can't have a situation where the price of a house stays at $1 million for 5 years, and the price of a movie ticket gets to $80. Prices are all relative, right? So we're moving money in and out of sectors all the time, and if so that's partly what's happening. We just have like had bad central banks for the last 20 years and too much currency in the system, and that, that some of that goes into housing. But also, we one thing that, and I get it, if I was a policymaker, I suppose I get it, but we just have quite a lot of population growth. So that they could solve this housing problem, which I never call a crisis, but we have a housing shortage, and they could just pause immigration for 2 years and let construction catch up. And no one wants to do that. And I get it. Like, we need a bigger population, I suppose, for geopolitical reasons. Fine. But I guess then let's not pretend that we're worried about a housing problem, because you could solve this. I mean, if we're net migrating 350,000 people a year, that means we have to build more than one Canberra every year. That's a lot. It's a lot of housing. It's a lot of housing that we're going to need. So I always feel like that the thing that we're not allowed to talk about is immigration, and I think that's part of this.
Yes,
I'm very pro-immigration, really. But it's also it's like Voldemort. We're not allowed to mention it. So I think that these are easily solved issues. But if we were allowed to talk about them honestly, I think that we might do things differently. But I think that's underlying all of this, really. Yeah. Because it's not that housing's cheaper. It's because if you want to live somewhere, you're going to have to join the feeding frenzy.
It's like everyone is being forced to play in this game, unfortunately, and the competition is already fierce right now, and it's just getting even worse with all that immigration tap that's been turned on. So that's the main issue we're seeing, unfortunately. But you're right. It could be as simple as just basically turning off the tap for a little while, in that sense, and stop immigration for a while and let the construction catch up to improve on the supply side equation. Anyway, okay, so, but yeah, looking at the table here, just quickly covering off. So Brisbane's obviously going very strong, 1.3%. Adelaide, very, very stellar performing, 1.7%. And Perth at 1.3% as well. So, and Sydney at 1%. So, these are the strong performers out of the cities. And Hobart is a minus 0.6% last month. So that's the only capital at the moment that's kind of going backwards right now. But yeah, as we kind of expected, the Brisbane, Adelaide, Perth are all in the affordable market bracket range. So, that just kind of shows where there's affordability, that's where the money's currently going.
Yeah, I think Melbourne's the most interesting. I mean, I don't know about any capital except for Sydney, so I don't want to project any expertise I don't have. But Melbourne is the most interesting capital to me right now. So, it's nearly 30% below the median price in Sydney, whereas it's probably going to overtake us in terms of population very soon. It's obviously got some. I think there's probably some institutional or political concerns there, but they would be short term. I wouldn't be worried about those. Just an interesting market. It just looks cheap to me in terms of the ratios that we do every 6 months. It looks cheap.
Yeah.
So there's that, and I think on the other side, Adelaide is starting to look a little bit toppy. So that's. I mean, I look at the CoreLogic daily indexes every day, and I'm always staggered to see how fast Adelaide is increasing in price. So well done to our listeners in Adelaide.
That's true. Whoever's got in early, I think that's always the case. And you look at how close Brisbane and Melbourne median value has been. It's about $15,000 at the moment. Kind of shows how vastly undervalued Melbourne is at the moment. So you're absolutely right. And if I could point out Hobart and Perth. So Hobart's median value is 658 and Perth's median value is 618. So imagine, just think about the two economy drivers in these two different capital cities. Perth being such a big mining player has an even lower median value than Hobart at the current stage. So that kind of tells you something, I say. So cool. All right. Well, let's move on. Okay. So we've got actually, this is an interesting graph, John. I think this is worth touching on. How much have dwelling values risen since bottoming out? So as at Sydney at the moment, which was, Sydney bottomed out around January 2023, we have gained 10.6% since then. We have gained 10.6%.
Since January. Right, okay.
Right, that's right. Melbourne, 4.3%. So Melbourne has still got quite a bit of recovery. Brisbane, 9.1%. Brisbane has also reclaimed most of its growth now. Adelaide, 6.3%, and that's from March. So Adelaide at the moment has obviously got a lower peak. A peak that came in a lot lower. So they peaked at March 2023, and therefore the dwelling value hasn't risen as much from since then. Perth at 8.8%, and the peak was September 2022. So, all these are pretty fascinating. Since the bottom, these capital cities, apart from Melbourne, at the moment, is one of the reasons why it seems to be so undervalued right now. But yeah, Sydney is definitely leading the bucks, John, in that case.
Yeah, interesting. I mean, the most recent data, in terms of the most recent quarter, it's all about Adelaide and Brisbane. They've outperformed, but I think that this is a very interesting chart. So going back to the bottom, or their respective bottoms. Yeah, interesting. Yeah.
Okay, so. All right, but yeah, for anyone who's interested, that's on page 2 of the hedonic index. Certainly have a look at it. All right, moving on to the next narrative. So the trend, this is talking about the advertised stock level, John, the one that you mentioned before. The trend in the advertised stock level is key influence on housing values. The flow of new listings has been on an upward trajectory since early June, bucking the normal seasonal trend when new listings are typically flat to falling through winter. Over the 4 weeks ending September 24th, the flow of new capital city listings was 14% higher than at the same time last year, and 8% above previous 5-year average. Okay, so this is talking about the new listing. So how many more properties are being advertised on the market? So we're talking about over the 4 weeks ending September, so basically from end of August to September, the capital city listings was 14% higher than same time last year and 8% above the previous 5-year average. So in other words, we are seeing a lot more new sales listings coming on the market at the moment. Okay. So that's increasing supply. So think of it like you're turning the tap on a lot more. So, it's filling up the bucket a lot faster at the moment. As the number of freshly advertised properties increase, there's also been an upward swing in the total number of homes advertised for sale. So this is talking about the total listing here. Although the total capital city listing remained below last year, so in other words, the available properties for sale, the total available properties for sale is still below last year and less than 5-year average, there is a clear upswing in available supply. The rolling 4-week count of total listing is up 6.7% from the low point in early July. Okay, so I think a few key here is, I had to read this paragraph about a few times to really understand it, but the new listings, the number of new listings is increasing and is above last year and above the previous 5-year average. So in other words, a lot more people are putting their properties on the market for sale. The total listing, however, in other words, the total property that's available for sale is still below last year and still less than 5-year average at the moment. Okay, but that could change. Okay, so the total number of properties available could change. And what that means is more listings imply more choice for buyers, and more choice means less urgency, more time to deliberate on the purchase and negotiate with the vendor. The total listing trend remains diverse, with an above average number of homes on the market in Hobart, Canberra, and Melbourne. Okay, so above average number of homes on the market. So in other words, they have a lot more available for sale. At the other extreme is Perth, where total advertised supplies was 43.8% below 5-year average.
Wow.
For this time of the year.
Wow. Okay.
Yeah, it's nuts. I mean, how do you interpret this, John? I think the way I look at it is, it's even though we are still seeing a supply issue, in other words, people are still struggling to buy or to find a property to buy because there's just not enough, but that seems to be changing. So that could have an impact in terms of the price growth in the next 3 to 6 months as the number of properties continue to increase. In other words, the supply continue to increase and the available properties for sale continue to increase. So that could dampen the growth What do you think?
Look, absolutely. But I think that there's the concern I have with this data is that it's not relative to population growth. So, let's say, I think we said that total supply is about 7% lower than the average of the last 5 years. I think it was something like that, or lower than the prior year.
Mm-hmm.
We have 400,000 more citizens than we had a year ago. So it's not just that it's 8%. There's 8% fewer houses. We need 8%. There's 8% fewer houses plus all the new people looking for accommodation. They're either, I mean, like, putting the details aside, they're either going to be renting or buying, but they need to live somewhere, and we just don't have enough places. So we've got 8% less stock available for people to buy. 400,000 more people than this time last year looking for places. So I think the supply data, the way CoreLogic presents it, which is excellent and the best we have, it still doesn't really capture how acute the problem is, because it doesn't take into account percentage of population or percentage of dwellings available. So this is why when the vacancy rates come out, and I haven't seen them, but I believe the vacancy rates for September are down again. So like, I think the vacancy rates are 0.8% or something like that.
Combined capital at 1%, basically. So that's the red line here, 1%.
Right. I mean, that's insane. That is so. That's the best indicator we have of just how scarce real estate is. I mean, the vacancy rate should be about 2.5 to 3% in a healthy market. Where Sydney's probably under 1%, but let's say 1% nationally. That's the best statistic for understanding, relatively speaking, how scarce accommodation is in Australia. It's very, 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 very tight.
10-year average was 2.8 for
capital. There you go.
Yeah. All right, so there you go. So combined capital is currently sitting at 1%. So that kind of just shows how dire straight the situation is.
Which means that there's like 75%, relatively speaking, less accommodation available for people looking than there was over the average of the last 10 years. If you've gone from 2.8% to 1%, my gosh, that's a key statistic.
That's for sure. All right. But yeah, look, coming back to this, are there any other commentaries around, around what we spoke about here? No?
No, not really. I mean, there's nothing volatile in that data set. I mean, it's either a little bit above or a little bit below. So no, I mean, hopefully it's what you want is supply to rise moderately every year.
You would, correct. In an ideal world, that's obviously wanted to be the case, but in real world, I don't think will ever happen. Yeah. Okay, talking about changing in rents then. Okay, so the national rent increased a further 0.7% in September, taking rents 6.4% higher over the first 9 months of the year and 8.4% higher over the past 12 months. So that's still quite strong in terms of the rental growth. The rise came as vacancy rate dipped again, dropping to 1% across the capital cities and 1.2% across regional Australia, both a record low for these series, which commenced in 2006.
Wow.
So, yeah, as you know, this graph basically tells it all, as we can see, right? Like we got it to about, September 2019, and then it's pretty much all the way coming down like a sliding escalator.
Yeah, rentals are the canary in the coal mine for your accommodation. So it responds a lot more quickly than the buying market to scarcity. So the rent market is what you need to look at, to be able to determine how scarce the market is. And it's very tight.
And although vacancy rate has tightened, but the pace of rental growth is easing in most markets. So I think this pretty much is best presented in this by this graph as well, to a degree, are the rents and units. The trend for units certainly is all seem like it's starting to dip down. So in other words, the rate of the growth in terms of the annual rental change is slowing. It's still growing, but it's
dipping
slowing.
to 14%. Yeah.
It's still staggering, to be honest. But if you look at, I think the trend is what we're looking here. And my gut feeling is, there's obviously an affordability ceiling in terms of how much people can afford to pay from a rental perspective as well. So we might not be too far away from that ceiling at this point. Therefore, people just can't afford it. So therefore, it's starting to slow. Natural part of the course, basically. So, yeah. And as rental growth slows and housing value rise, the trend in gross rental yield has once again reversed. So this is, John, you and I spoke about this earlier, because we would have thought that the yield would be continuing to improve. But as a matter of fact, the past 5 months has seen dwelling values rise at a faster pace than rents, basically sending the gross yield mildly into reverse. So in other words, the price is actually going up a lot faster than how the rent's still going. The rent's already going up very, very quickly, as we can see right now, but it's just mind-boggling when you can see the price is actually going up even faster. So the yield has actually gone slightly backwards, not upwards. Yeah.
Yes. Yes. So what this tells us is that people aren't piling into the property market because it's suddenly become this amazing investment and it's just cash flowing, and the rents are up and it's paying for your mortgage and all that sort of stuff. Nothing like that.
Nothing like that.
Prices of properties are going up for the same reason rents are going up, and that's because there is a shortage, not a crisis, just a shortage, and that's the reason. I mean, we have an imbalance of demand and supply in the country. I mean, that's the reason. Yeah, it's not the yield. So the yields, I think, they've moved from about 2.5% at the peak up to about 3 to 3.1% now. So I mean, that's good. It's an improvement. It's a rebalancing at more normal levels of yield, but it's still not a hugely compelling reason to go out and buy an investment property. But you're not doing it because the rent is amazing.
No, unfortunately not. So. All right, so I think that's pretty much what we had to cover out of this report. Is there anything else that you found interesting, John? You like to any final remarks on this before we move on?
No, nothing we haven't already said. Good.
Awesome.
Good chat.
All right, well, let's change gears a little bit, and let's have a chat about, do some property talk, I should say, which is also one of the very exciting things that we speak about. So this week we want to talk about, as an investor, one of the how do you phrase this? One of the key questions that you ask yourself: property type versus location. Okay, property type versus location, which is more important and why, as an investor? Okay, so
good question,
John. You and I probably have opposing views on this, but anyway, I think it's good to us to have a chat about that. Again, this is all we didn't pre-record this or anything. It's spontaneous, everything along that line. So I think will be a good one to chat out. So location and property type. Would you like to start, or would you like me to start?
I was going to handball it back to you, actually.
Okay.
Do you want to go first?
Okay. All right. Look, so as a property investor, I think, they always say location, location, location at the end of the day, right? Location is the thing that cannot be changed. Property type, maybe, depending on what type. Okay. So, but let's just use it as an example. Would you be looking at buying a house with a block of land, maybe 600 square meters in Schofield? We're talking about, 40 kilometers northwest of Sydney Central CBD, as opposed to maybe a 2-bedroom unit in Inner West. So that's a clear contrast in terms of property type and location. Obviously, the Inner West will be a lot closer to the city, will be a lot more commutable for those people who need it, as opposed to a potentially a big house out in Schofield with a big block of land.
Yep.
So we all know from principles that land is the one that grows in value, not dwelling. Dwelling is the one that depreciates, right? So in theory, you will probably want to keep that. You want to buy something with as much land component as you possibly can. But in reality, is that really going to be the best investment in terms of the capital growth prospects? I guess that's really the question that we're trying to solve here, right? So, look, personally for me, if I have got the capacity to be able to afford to keep on those mortgages and to buy big block of land, even though it's further out, I will probably still pick that. I'll probably still pick that over potentially, in this example, a 2-bedroom unit in Inner West. Okay. That's just put it in that perspective, I would probably choose, in this case, land/property type over location/property type. Okay. That's my personal view. If my pocket is deep enough to be able to hold that for long term, I think the land is always going to be the one that continues to go up. Whereas, the block of units in Inner West, and again, I'm using Inner West not because I don't like or anything like that, but there's still chances of it being redeveloped, and they could potentially release some more high rises down the track as well. So that could dampen the capital growth prospects on that either. Okay, so I'm leaning more towards the further block out, but having a house on that. But keen to hear your thoughts, John.
Yeah, I mean, there are examples that go both ways, but if I had a gun to my head and I had to choose a particular strategy, I prefer the location over the property type. Okay. So if it was a terrace in Paddington versus a house in Seven Hills, I would prefer the terrace in Paddington. Uh-huh. Although they may not be at the same price point actually, but generally speaking, something like that. Now there are examples where if you get too generic, like I would prefer a house in Blacktown over a unit in Ashfield, and I love Ashfield. There are some fairly generic property types that are going to underperform. But right. Generally speaking, location for me, generally speaking, macro themes end up, I think, winning out in the end. So I think I prefer the closer in locations over the house in outer suburbs with more land. But I mean, in my head, I'm just going through my Rolodex of times when that hasn't prevailed. But so I can see the other side.
Funny you said terrace in Paddington, because that's a different property type as opposed to what I have mentioned. That's right. Right? Like, yes. Yeah. And what
about a 2-bedroom unit in Manly? I would buy that any day of the week, or a 3-bedroom unit in Coogee. Those are great properties. So if I had to, a couple of caveats here. We like nuance at Spark Your Fire, so we like to give sort of strong, detailed responses, and we don't always give the short soundbite. But firstly, I think whether you're buying a unit, I think I prefer location, but in these locations, I think you need to know whether you're buying a unit or a house.
Yeah.
And there is a way to think about which is undervalued. You might have heard us talk about this in the past, but you want to buy a unit in a location where the house to unit ratio is at least 3-1. So you would not buy a unit in Campbelltown, but maybe you would buy a house. You wouldn't buy and so on. And so, but there are, a unit in Double Bay or Mossman is 4 times, a house in Double Bay or Mossman is 4 times the value of a unit. So their units are quite relatively inexpensive. So Mossman, Double Bay, Coogee, you'd buy units and that would be perfectly fine. So there is some nuance. You want to have a look at those ratios of houses to unit prices to give you an indication of what is relatively better value in those areas.
Yep.
Yeah, and I had one other thing to say, and I've forgotten it actually. But for now, let's go with that. Any thoughts on the ratio? No,
look, I think that's a great thing that you pointed out. I would also like to add in a scarcity factor as well. Like I said, if you're within that suburb, there's always going to be a more predominant type of dwelling over the other. So, whether that's going to be 70% units and, 10% townhouses and 20% houses, that kind of things. You certainly want to pick the type of dwellings that has a more scarcity over the other. Yeah. So, in that scenario, you wouldn't want to be buying a unit within a 70% unit dominated suburb.
Yeah.
And look, same thing as I generalized in my previous response, if you're looking at like a 200 square meters block that's being subdivided and, everyone's got the cookie cutter type of houses, that's probably not the best investment when you're looking at further out in Schofields. What I had in my mind is probably just a standalone without being cutted out and, had its own type of character. So the property itself will still have differentiation from everyone else. It's unique by itself. So, the question here is looking at scarcity. the uniqueness of the property as opposed to the one of the 2-bedroom units that's being built within hundreds and hundreds of development complexes. Everyone looks the same in that case. Okay, so there is that scarcity factor in my mind as well when I was answering this question previously. I think the units in Bondi that you mentioned, obviously there's scarcity in that, whether it's from a location perspective, whether it's from a unit perspective, and perfect example in that sense. Whereas so I think certainly it's there's no right or wrong answer here. Of course, at the end of the day, and again, it looks like from a snapshot perspective, 20 years ago, if you compare Bondi, a 2-bedroom unit Bondi as opposed to, I don't know, say Seven Hills House, in that case, the value might not be that much of a difference, but over a period of time, the location and the land value as it gets redeveloped and zoned, it will start to show differences from that point onwards. And it just comes down to, as I said, how deep is your pocket in that case? A house would always require higher maintenance cost in general. And there could be, roofing issues, repainting issues, that kind of stuff. Whereas units, I mean, don't get me wrong, you'd probably still get hit from hefty strata fees from time to time as well. But, at least if you pick the right units and there's solid bricks, then you minimize the risk of having to pay those. So
I just add a footnote as well, and I'm very guilty of this. So I talk about units versus houses. We do this almost every week on this show, but I want to do a carve out to an often forgotten sort of property type, which is the 3-bedroom unit. The 3-bedroom unit, they don't, when they build the big apartments, they generally don't make a lot of them. But the 3-bedroom unit, the humble 3-bedroom unit, has really outperformed over the last 10 years, when for a lot of that time units have not done that great. So houses have really done very well over the last sort of 5 years, but units haven't, with the exception of the 3-bedroom unit. So what I would say is, an old 3-bedroom walk-up apartment let me give you an example. Units are not scarce in a suburb like Lane Cove, and Lane Cove is a very sort of it's a high demand suburb, high supply suburb. 3-bedroom units do great in Lane Cove because there's not many of them. So I just want to sort of add some nuance to this sort of unit versus house debate, to throw in the 3-bedroom unit, which appeals to upsizers and downsizers, and that seems to be a very on-trend acquisition type in Sydney over the last 5 years. So if we were to say comparing 3-bedroom units to houses in outer suburbs, 3-bedroom units probably done quite well.
Yeah. No, that's very true. So it comes back to scarcity again, and is it unique in that sense? I think I actually saw 1 4-bedroom units once.
They
that would have been then rares the hens hens teeth in that case, isn't it? So have you actually seen a few of them 4-bedroom units?
I bought a 4-bedroom unit in Kirribilli a couple of years ago, and they turned the 4th bedroom into a media room. But so they exist.
They do exist.
They exist.
They do exist, just not as common as 2-bedrooms that we see nowadays, flocking around the whole time.
That's right.
All right, fantastic. Thanks, John. Anything else? Any last remark on this?
No.
Okay. Awesome. All right. Well, look, thank you guys again for joining us for another episode of Spark Your Fire. And have a good week, and I look forward to see you again in the next episode. Cheers. David, John.